historic shift is unfolding in gold and silver, and the market still hasn't fully priced it in. Gold is holding near $4,600 after a violent drop. Silver just bounced back towards $75 after being crushed earlier in the week. And right now, traders are staring at a market that looks calm on the surface, but underneath, something much bigger is building. Because this is no longer just a price move. This is a battle between inflation, interest rates, and trust. And one hidden signal could decide whether gold pushes toward $5,000 or breaks down again from here. Let's break this down step by step. Right now, gold is hovering around the $4,600 level after the Federal Reserve decided to hold rates in the 3.5% to 3.75% range. At the same time, silver is trading near $75 after a sharp rebound from the low $73 zone. That might sound stable, but this is not stability. This is tension. Because the Fed didn't just hold rates. It sent a message that inflation is still a problem. A message that rate cuts are not coming anytime soon. A message that markets may have been too optimistic, and that changes everything. Here's what nobody sees. Gold didn't crash because demand disappeared. It dropped because expectations changed. Markets were pricing in easier policy. Now they are being forced to accept higher for longer. And when that happens, gold feels pressure. Because gold doesn't pay yield. When interest rates stay high, investors can earn returns elsewhere. That shifts money. Now look deeper. The US dollar is still holding firm near the 98 level. That matters because a stronger dollar makes gold more expensive globally. At the same time, real yields remain elevated. And that creates a powerful headwind. So now you have a situation where gold is being pulled in two directions. On one side, you have central bank buying, geopolitical tension, and long-term demand. On the other side, you have high rates, a firm dollar, and inflation pressure. That tension is exactly what creates volatile markets. And we are seeing it right now. Silver is reacting even more aggressively. Because silver is not just a precious metal. It is also an industrial metal. That means it depends on growth. If the economy slows, industrial demand can weaken. And when you combine that with higher interest rates, silver can drop faster than gold. That is exactly what happened earlier this week. Silver plunged towards $73, breaking key levels before bouncing back. But this matters more. Even after the drop, silver is still supported by a long-term supply deficit. This is the 6th straight year of structural shortage in the silver market. Industrial demand from solar, AI infrastructure, and electronics is still strong. So while price action looks weak in the short term, the underlying story hasn't disappeared. That creates a powerful setup. Short-term weakness, long-term strength, and markets often move hardest when those two collide. Now let's talk about what just changed in the macro picture. The biggest shift came from inflation expectations. Earlier, oil prices surged due to tensions involving Iran and uncertainty around the Strait of Hormuz. That pushed inflation fears higher. But then something unexpected happened. A peace proposal emerged. That cooled oil slightly. And suddenly, markets had to reassess everything. This is where it gets interesting. Because now, traders are stuck between two narratives. One says inflation remains sticky and the Fed stays hawkish. The other says growth could slow, forcing the Fed to pivot later. And gold is caught in the middle of that debate. Here's the signal. Gold holding $4,600, despite all this pressure, is not weakness. It may actually be strength. Because if gold were truly broken, it would have already collapsed further under these conditions. Instead, it is stabilizing. And that suggests buyers are still active. Who are those buyers? Central banks, institutional investors, long-term wealth preservation strategies. Reports show continued accumulation from countries like Poland and strong demand from Asia and India. That is not short-term speculation. That is strategic positioning. Now, we are approaching the midpoint of this story. And what silver does in the first 15 minutes after the next major data release or Fed signal may reveal the next 3-month trend. If silver breaks above $76 and holds, it could signal that buyers are regaining control. If it fails and drops back towards $73, it could mean the market is still under pressure. And if gold rises while silver lags, that tells you something even more important. It tells you the market is moving into defensive mode. That difference matters more than most people realize. Because gold leading alone is fear. Gold and silver rising together is momentum. Now, let's go deeper into what smart money is likely doing. Institutions are not reacting emotionally. They are watching flows. They are watching central bank purchases. They are watching ETF inflows. And despite the recent drop, inflows into gold and silver ETFs have remained strong. That means someone is buying while others are selling. And that is how markets redistribute assets, from weak hands to strong hands. But here's what nobody sees. Markets don't move based on what is happening now. They move based on what is expected next. And right now, expectations are shifting rapidly. If inflation stays elevated, the Fed stays tight. If growth slows, the Fed eventually pivots. Gold benefits in both scenarios over time, but the path will not be smooth. Silver will be even more volatile. Now let's talk about what this means for everyday investors. Most people look at this drop and feel uncertain. They see gold falling during geopolitical tension. They see silver dropping despite strong demand. They wonder if the trend is over. But the reality is more complex. This is not a simple uptrend or downtrend. This is a transition phase. Markets are repricing risk. They are adjusting to a new reality. Higher inflation, higher rates, uncertain growth. And that environment creates opportunity for those who understand it. Now let's walk through the three most likely scenarios from here. Scenario 1. The Fed remains firmly hawkish. Inflation stays sticky. The dollar strengthens further. Gold struggles to break higher and could retest $4,550 or even lower. Silver could drift towards $72 or below. Scenario 2. The Fed stays cautious and data dependent. Markets remain volatile. Gold trades between $4,550 and $4,700. Silver moves between $73 and $76. No clear trend, just chop. Scenario 3. Growth weakens faster than expected. The Fed signals future easing. The dollar softens. Gold breaks above $4,700 and moves toward $4,900. Silver accelerates towards $78 and beyond. But here's the twist. All three scenarios still point to one thing: volatility. And volatility creates opportunity. Now, let's close the loop. Why are gold and silver behaving this way right now? Because the market is not reacting to one factor. It is reacting to multiple forces colliding at once. Inflation, interest rates, geopolitics, currency, strength, and long-term demand. And when all those forces collide, markets become unstable. That is exactly what we are seeing. So the real question is not whether gold and silver will move. The question is how they will move next. Will this rebound turn into a breakout? Or will it fail and lead to another drop? That answer may come faster than most expect. So what do you think? Is this a setup for gold to reach $5,000 or the beginning of a deeper correction? Drop your view in the comments. And if you want clear, no noise analysis that keeps you ahead of the market, subscribe and stay close to the signal.